All right, let's talk about it. GameStop and AMC. You've heard the names, you've seen the headlines. In the last few years, these companies became the center of a financial earthquake. And it wasn't really about movies or video games. It was about a movement that absolutely rocked Wall Street. So what really happened? Let's break it down.
To really get why millions of people were glued to their screens, you have to understand the story. And this headline, it just says it all. A classic David versus Goliath fight. This wasn't just seen as trading stocks. For many, it was a populist uprising against the giants of the financial world. It felt like a real battle.
So, what even is a meme stock? Forget all the complicated Wall Street jargon for a second. It's actually pretty simple. It's a stock whose price goes wild, not because the company's profits are soaring, but because a massive community of regular investors, online, decides they believe in it. Their collective energy and buying power is the rocket fuel.
Now, to really understand this whole saga, we got to look at the two main characters, AMC Entertainment and GameStop. So let's start with the basics, what these companies actually were before all the madness began. First off, what do they even do?
Well, AMC, as you probably know, is one of the biggest movie theater chains in the world. And GameStop, they're the classic brick-and-mortar store that sells video games and consoles. The thing is, both of them were facing some pretty serious challenges, right? With streaming services and digital game downloads becoming the norm.
And right here, you can see a huge difference in how the market valued them. Market cap is just a fancy term for the total value of all of a company's stock put together. And at the time of this data, the market was basically saying GameStop was worth over 8 times more than AMC. That gives you a little window into how investors were thinking about their size and potential.
So, what's the ride been like for people holding these stocks? Well, this year-to-date performance shows it's been rough, a really bumpy ride. Both stocks are down significantly. And that's a crucial piece of the puzzle. Despite all the hype and the incredible spikes, holding on has been an incredibly volatile experience.
So, if the basic business plans were looking a little shaky, why did these two specific companies become the center of a financial war? Well, the answer comes down to one key idea that basically fueled the entire fire: the short squeeze. It all kicks off with this question. And honestly, if you can understand the answer to this, you've unlocked the key to the entire story. So, what exactly is short interest?
Okay, imagine you could bet on a horse to lose a race. That's pretty much short selling. Big investors, like hedge funds, were looking at struggling companies like AMC and GME and betting that their stock prices would drop. They borrow shares, sell them, and then plan to buy them back way cheaper later, and they pocket the difference. The short float just tells us what percentage of a company's shares are being used in this bet against it. Let's look at the actual numbers. For AMC, the short float is 9.65%. So think about that. For every 100 shares available out there, almost 10 of them are being used by investors who are betting the price is going to fall.
And then we look at GameStop. The number is way higher, 16.20%. A much, much bigger chunk of its shares are being shorted. And this huge level of negative bets against it, well, that's exactly what made it such a tempting target for a counterattack.
And here it is. This is the big light bulb moment. Retail investors on forums like Wall Street Bets saw this huge short interest not as a sign of company weakness, but as a vulnerability of the short sellers. They realized if they all bought the stock and just held on, they could drive the price up. That would cause catastrophic losses for the hedge funds. And to stop the bleeding, those short sellers would be forced to buy back shares at a higher price, which of course creates even more buying pressure, sending the stock to the moon. That is the short squeeze.
But the story gets even deeper. Beyond just buying shares, a lot of the most dedicated followers dive into the crazy world of options trading, and they're always watching for signals. One of the concepts they talk about the most is something called max pain.
So let's just ask the question straight up, like before. What is this mysterious max pain theory all about?
Investopedia defines it pretty well. Max pain is a theory that suggests a stock's price will tend to drift towards the exact price point where the largest number of options contracts expire completely worthless. It causes the most financial pain to the most people holding options. It's a controversial theory for sure, but a lot of traders watch it like a hawk.
To make this real, just look at the data. For an upcoming expiration date, GameStop's max pain price was calculated to be exactly $24. So believers in this theory would be watching really closely to see if the actual stock price gets pulled toward that $24 mark as the deadline got closer.
Okay, so after all this data, all these charts and theories, it's so important to remember that this phenomenon isn't just about numbers. At its very heart, it is about a powerful, internet-driven culture of community that's had some very real-world impacts.
I mean, look at this. Once AMC found itself with this massive, loyal, and super vocal group of new investors, its entire corporate strategies started to change. The company announced plans to start selling its famous movie theater popcorn outside of its theaters. That was a move that directly played to the enthusiasm of its new shareholders.
And the engagement got even more direct. AMC's CEO, Adam Aron, started talking directly with his investors on Twitter. He even offered them special NFTs, these non-fungible tokens, just as a thank you for their support. I mean, that level of direct communication between a CEO and regular investors is so unusual, and it just shows how much the game has completely changed.
And this slide right here, this points us straight to the engine room. You'll see headlines all the time tracking the most mentioned stocks on Reddit's Wall Street Bets forum. And this isn't just for kicks, it's a real sentiment gauge. The amount of chatter and excitement on these forums can directly link to a stock's volatility and how much it's being traded.
So, what are the big takeaways from all this? Well, first, meme stocks are a hybrid. They're fueled just as much by community and belief as they are by financial data. Second, key numbers like short interest aren't just data points. They become the entire plot of this dramatic story. They literally create the battleground. And finally, this whole movement has had a real tangible impact on how companies work and how they talk to their investors.
You know, all this leaves us with a really fascinating and kind of fundamental question. We've always been taught to analyze the data on a company's balance sheet to figure out what it's worth. But in the age of meme stocks, when passionate belief itself becomes one of the company's biggest assets, you just have to ask, what does the data truly mean anymore?